U.S. stocks weakened amid multiple negative factors, with all three major indexes closing lower and risk aversion rising continuously. Non-farm payroll data fell far short of expectations, and coupled with tensions in the Middle East and surging oil prices, concerns over inflation and policy pace intensified. Capital flowed to safe haven and inflation-resistant assets, putting risky assets under general pressure. Next, at the close on March 6th Eastern Time, the Dow Jones Industrial Average fell 453.19 points, or 0.94% to 47,501.55. The Nasdaq Composite dropped 361.31 points, or 1.59% to 22,387.68. The S&P 500 lost 90.69 points, or 1.33% to 6740.02. The three major indexes traded weakly throughout the day, with the Nasdaq and S&P 500 falling more sharply. The adjustment pressure on growth sectors was significant, and market trading sentiment was cautious. Sectors showed a broad decline, with technology, industrials, and materials leading the market lower. Large-cap tech stocks more generally fell, with Nvidia and Intel among the top losers. Amazon, Tesla, and Meta weakened simultaneously, while Apple, Microsoft, and Google adjusted slightly. The energy sector closed higher against the trend, supported by a sharp rise in international oil prices, becoming one of the few bright spots in the market. Defensive sectors were relatively resilient, while finance, consumer, and aviation sectors weakened significantly. The market lacked a clear leading direction. Chinese concept stocks were mixed, with some targets strengthening against the market, and overall performance outperformed the U.S. stock market. On the macro front, U.S. non-farm payroll data for February was far lower than expected, sending a signal of economic slowdown. Meanwhile, the ongoing geopolitical conflict in the Middle East continued to disrupt energy supply, and the surge in oil prices boosted inflation expectations. This caused the Federal Reserve's rate cut expectations to swing again. U.S. bond yields fluctuated more, suppressing the overall valuation of the stock market. Corporate profit expectations faced dual pressure. High valuation growth sectors entered a phased adjustment, and capital turned to safe haven and low valuation directions for safety margins. Commodity markets performed strongly, with energy and precious metals rising sharply. International oil prices soared, with both WTI and Brent crude hitting stage highs. Supply risks and geopolitical premiums pushed oil prices higher continuously. Spot gold and COMEX gold futures closed higher simultaneously, with safe haven and inflation-resistant demand jointly are supporting the precious metals market. The US dollar index fluctuated slightly, non-US currencies performed steadily, and global capital flows clearly pointed to safe haven assets. Looking ahead, US stocks will remain dominated by economic data, geopolitical situation, and Federal Reserve policy expectations in the short term, and market volatility may remain high. Safe haven assets such as energy and gold have allocation value, and the adjustment pressure on technology and growth sectors has not been fully released. Operationally, it is recommended to strictly control the overall position, increase allocation to defensive assets such as energy and precious metals, avoid high valuation sectors, track the follow-up impact of non-farm data and the progress of geopolitical conflicts, and wait for market sentiment and policy expectations to gradually clear.